Is this the day we break 3 days of gains? We're down by 1/3%, 30 minutes until the start of your cash equity trade. I'm Dani Berger. Matt Miller off this week. Bloomberg Open Interest starts right now. Coming up, Walmart gives a cautious outlook. The world's largest retailer cites concerns about trade and labor. And it's not just Walmart. Investors are sifting through a mixed bag of earnings this morning across multiple sectors. We'll break it all down for you. Plus, record-breaking funding. OpenAI is said to be finalizing a deal that could bring in more than $100 billion. Let me show you what Walmart has been doing, because this has been a volatile morning. So the earnings first come out, and Walmart drops pretty significantly. But then there's this idea maybe they just set expectations low. We're going to talk to Emily Cohen about this in a moment. It moves flat to slightly higher, and now it's down about 0.2%. There's Deere. They raised their profit outlook. Executives say that 2026 is the bottom of an agricultural economic cycle. Shares up 5.5%. Figma shares up 7.7%, easing fears over AI disruption for the software company. So follow me over to the desk, because we want to get more into those Walmart earnings. And as promised, Emily Cohen joins me for more on that. Emily, let's maybe start with the craziness of the price reaction. Do you think maybe some of the fears have ebbed, because this is a company that typically gives a conservative outlook to start the year?
I think that's right. So we don't usually see Walmart stock this volatile. It's moving around quite a lot, within a small range, but it's jumping around. I think this was expected. Walmart generally does issue conservative outlook at the beginning of the year and then surpasses those numbers as the year goes on. So from that respect, it can be expected. But they did call out some macro factors, the job market specifically, trade headwinds, that do give investors some worry.
So how do you, or can you even extrapolate this into wider consumer sentiment, just given what a behemoth Walmart is?
Yeah, Walmart definitely has its advantages with the trade war. They have their advantages in that they're they have the best relationships with suppliers given their vast size, and they can eat the cost of the tariffs better than anyone else for the same reason. But when you see things like this jobless boom that we wrote about yesterday, with the economy adding a lot in capital but not so much in jobs, that is a real concern for a place like Walmart. Those people need, their shoppers need jobs in order to keep spending. So I think that's what we saw reflected a little bit in their conservative outlook.
Yeah, in the words of the CEO, fluid, dynamic, macro backdrop. Emily, thank you so much for joining
you,
on
Dani.
this. Bloomberg's Emily Cohen, and we're going to have more on Walmart in just a moment. Sucharita, Kodali of Forrester Research will also be joining this show. That happens in about 10 minutes' time. In other earnings, Deere boosted its guidance for the year as it sees the agricultural economy improving. Bloomberg Intelligence Industrials analyst Chris Ciolino joins us now for more. Chris, what was your read on the Deere earnings?
Yeah, it was really a solid beat and raise quarter, and I think this gives us the all clear on the cycle and that earnings will bottom this year. The 1Q beat, it was broad-based, right? I mean, you saw top and bottom line beats across the board for all their segments, with particular strength in the small ag business and construction as those markets begin to recover. The large ag business, which is, the growth engine here, still remains, quite challenged, but that market seems to be stabilizing.
How do we then square this with one of their big competitors, CNH Industrials, coming out and saying the bottom isn't quite here yet, that the recovery happens in 2027? How do you make sense of those two conflicting views?
Yeah, I actually think they're similar, right? Earnings will bottom this year. We think the North American large ag market will bottom this year. I think what's still up for debate is the trajectory of this recovery. Right now, we see, with crop prices, continuing to hover at pretty low levels, farm income challenged. You still have lingering trade uncertainty. We think the recovery trajectory is maybe a little bit slower than what we have typically seen in a cyclical recovery. But I don't think there's really much question that, 26 should be the bottom of the cycle.
How are costs looking for machinery specifically, Chris?
How are costs looking?
Exactly.
Yeah, so tariffs are the big headwind this year. Deere, I think, is expecting tariffs to step up or nearly double to about $1.2 billion. It's pretty consistent across the board with the machinery universe, with tariff costs nearly doubling. The big question now is what price realization will be in 26, how much are they able to pull on that pricing lever, and what other cost mitigation actions they may use this year.
Chris, what difference does it make having a president saying that China is going to be upping their soybean purchases? I think something to like $8 million to start the year. Are we seeing any impacts of that on the farming industry?
Not yet, right? So it certainly helps, I would say, with sentiment and confidence. But I think this is very much a show me story. So when we actually see tangible evidence of more crop exports going to China, I think that will certainly help provide a little bit of stability on the crop price front. And then maybe you start to begin to see farmers go out and replace equipment. But it's very much a wait and see mode right now.
We're not waiting and seeing for Deere. Again, shares up pretty nicely so far in the pre-market this morning, up 6%. Chris, thank you so much for joining us. Bloomberg Intelligence Industrials analyst Chris Ciolino. Now to a Bloomberg scoop. OpenAI is close to finalizing the first phase of a new funding round that is likely to bring in more than $100 billion. Bloomberg's Tech's Ed Ludlow broke the news and joins us now. And Ed, as I just mentioned there, it seems like $100 billion might only be the beginning for this round.
Yeah, only the beginning. Call it portion number one or phase number one. And what we understand from sources is that is basically dominated in the first instance by strategics. Amazon, SoftBank, Nvidia, Microsoft, pretty much in that order. And there's been the reporting around that Amazon's contribution, for example, investing for the first time into OpenAI could be $50 billion. The other part that we're hearing, right, is that as this kind of phased approach where later they might give allocation to sovereigns and venture firms, the overall total target raise goes up, the post-money valuation could hit $850 billion. So, you know, it's happening. And like towards the end of this month, that first part, at least, our understanding is that those strategics, those big Mag 7 names and SoftBank will close or firm up their agreements in what they want to give OpenAI, and then it will go from there. And my goodness, I think it is the biggest round by a single company of all time.
I also just wonder if this should alleviate some of the anxiety, some of the skepticism and pressure about the capital intensity of OpenAI, because presumably this leaves them fully funded through, 2030, Ed?
You'd hope so. They're massively committed to infrastructure build out. The consistent message from OpenAI is that they are constrained by compute. And that manifests in that they're constrained in the additional tools that they can put out there, the developer access that they can give. We do know from the middle of January that annualized revenue hit about $20 billion in 2025. So revenue is growing, year on year at more than 200%. But still, it's a frighteningly big number in the end that OpenAI sees it needing to spend. In some cases, it takes on the capital burden to build out infrastructure, and by that we mean buy the chips, put them into data centers. In others, it's relying on partners. But yeah, the other thing as well is these are strategics. I'm really interested in who comes next. If they're going to go public, as has been discussed, you don't see any of the sort of crossover type investors in that list right now. Maybe they'll come later, and that will give us something to look forward to this year or next.
Ed, we have to talk before you go. The big interview of the day is your interview with Ted Sarandos of Netflix. So much is happening there. What do you plan to ask the co-CEO, Ed?
Well, you and I talked about the status quo right now, which is that Netflix has given Warner Bros. Discovery the waiver to talk to Paramount, which expires on Monday. So everyone's waiting on Paramount to do something. But I guess that it simply comes down to what is the means and the will that Netflix has to boost its offer, number one. And then maybe you saw the reporting overnight from our colleagues in Los Angeles. The government lawyers from an antitrust perspective are now going to the movie theaters and saying, what will the impact on you be if Warner Brothers Discovery's business or parts of it are acquired? What will that look like for the industry? That's kind of the big question. So I think that's all fair game for us to talk at about 12:30 Eastern Time, 9:30 a.m. Pacific later today.
Really looking forward to that. Ed, thank you so much. Bloomberg Tech's Ed Ludlow, and he mentioned Netflix co-CEO Ted Sarandos, 12:30 p.m. New York time. And later, the Figma CEO Dylan Field on Bloomberg Business Week, who also reported earnings. I know they'll talk about that on the tech tech show too, relieving some of the anxiety that AI might replace some of the Figma services. Let's get a check on futures on an earnings heavy morning, and we are falling 0.4%, comes off the back of 3 consecutive gains for the S&P 500, the first time we've achieved that in February. Tech that underperforms, down 0.5% for the Nasdaq. Russell 2000 underperforming even more as Brent crude spikes 1.7%. How much of what we're seeing in markets is anxiety over Iran, with an Axios story about just how far apart the sides are on reaching any sort of nuclear negotiation agreements. Let's get a look at some of the other movers on our radar this morning. Carvana profit took a hit from depreciation costs on its inventory as it aggressively buys used car shares, down 7%. Then there's DoorDash, orders topping estimates as it plans to expand beyond restaurant delivery. That plan and that expansion paying off in a big way, shares up 8.8%. Then there's Booking, reporting fourth quarter results that were largely ahead of expectations, but shares are dropping. Is it AI anxiety fears come to play, down 1.2%? And I'm going to be speaking with the Booking CEO Glenn Fogel later this hour, so stay tuned for that in about 20 minutes time. First, though, coming up, more on Walmart earnings in the retail sector with Forrester research analyst Sucharita Kodali. This is Bloomberg Open Interest. Let's get to some high-interest stories. A look at what's making headlines around the world. Former Goldman Sachs top lawyer Catherine Rumler exchanged emails with Jeffrey Epstein about the 2012 Secret Service prostitution scandal. Messages showed that she shared non-public details about the White House review after leaving her post as White House counsel in 2014. Rumler resigned from Goldman Sachs last week after this latest batch of emails were released and publicized. A spokeswoman for Rumler said she, quote, has done nothing wrong and has nothing to hide. Elsewhere, former Prince Andrew has been arrested on suspicion of misconduct in public office after further details emerged of his relationship with Jeffrey Epstein. King Charles says the law must take its course. Andrew, who turned 66 today, has consistently and strenuously denied any wrongdoing. Emails to a representative for Mountbatten Windsor's office weren't immediately returned. Former Prince Andrew has not been charged. Meanwhile, Apollo Global Management told clients its top executives had no business or personal ties to Jeffrey Epstein. Newly released Justice Department files name CEO Mark Rowan in past communications. The firm says any contact was limited to information shared for Leon Black's tax matters, and nothing in the new documents changes prior findings. We'll bring you any new updates as the Jeffrey Epstein emails have their consequences across firms. Back to equities, fluctuating consumer sentiment, a weakening jobs market, and trade uncertainty forcing Walmart to deliver a cautious outlook for the year. This despite topping analyst estimates. Joining us now is Forrester Research retail analyst Sucharita Kodali, and it's been a ride for Walmart shares pre-market. Now they're up 1%. Sucharita, I was listening on surveillance this morning to Mizuho's David Bellinger, who basically said this is a low bar set for the CEO's new year, and they're just going to continue to hike that as the year goes on. Are you seeing the set of Walmart earnings the same way?
Well, I think that the Walmart earnings have been pretty incredible for a business its size to be hitting mid-single digit growth numbers year over year is not a trivial task. They are on the path to be $1 trillion revenue company within our lifetimes. And the fact that at its size, it hasn't completely stabilized is in itself an accomplishment. You will remember that even just a few years ago, the growth numbers were much smaller and they were in the low single digits. So for it to actually be accelerating at its size when it is not fundamentally a tech company, it is a company that sells commodities and groceries. It really speaks to its execution, and it speaks to the fact that it's taking share from the rest of the retail industry.
It's not a tech company, but it is an e-commerce platform globally that grew 20% over the year. Their multiple certainly looks like one. I mean, they trade at 45 times forward towards earnings. That beats out Amazon. They traded a multiple of 29. Sucharita, does that make sense for a company which still at the end of the day is a retailer and not a tech play purely?
Well, I think that they are certainly trying to tell a story that they are getting closer and closer to a tech play. And in fact, that a lot of their ability to take share is coming from their technology investments. And of course, they too are playing the AI card, very similar to just about every other major company in the world. But in terms of, is it overvalued? I think that what you end up seeing when you have a company where the growth is accelerating, especially a large company, there is a lot of optimism as to how much more runway does a company like this have. And it seems to suggest that there's more growth to be taken, especially when its competitors are stumbling.
Its competitors are stumbling. Why, Sucharita? Is it pricing power of Walmart? Is it the move to e-commerce? Is it a consumer who's increasingly turning to Walmart instead of others? Well, what do you make of their ability to take a larger slice of the pie?
Well, certainly they are getting more consumers than they've ever had before, spending more of their wallet share. Some of that is coming when I say competitors are stumbling. You know, you look at a company like Target, and it's been more challenged. And historically, for probably the last couple of decades, Target has been one of the biggest competitors. And then you also have a number of smaller players, mall merchant types that have sold products in sectors that are big box or apparel. They too are stumbling. And when you see Walmart being able to gain greater share in sectors like apparel, that certainly is a factor at play. And e-commerce, no doubt, is part of it. They've certainly invested a lot in that. They have a marketplace, they have an ads business, which allows a flywheel of profitability that takes a page from Amazon for sure. So it is. So I think that's really the expectation and the hope of where Walmart will continue to go.
I'm just looking through the earnings call, ironically, the AI automation write-up of it. And they're talking a lot about AI in this, talking about their Sparky that helps enhance. They have partners like OpenAI and Alphabet looking for agentic commerce, saying that it was deployed 1.5 million associates here in the U.S. Has helped reach that inventory. How are you looking at their incorporation of AI, of their agentic assistant, and maybe other applications of AI that Walmart is using?
I'll be honest, when I look at companies and their AI announcements, a lot of it's a bunch of word salads. But the truth is that when Walmart is growing at the level that it is, a significant part of it is related to excellent execution. It is related to getting the right product at the right place, at the right time, at the right price for shoppers. And that is not a trivial task. There is a lot of AI that has nothing to do with generative that is driving the fundamentals of that business. And I have 100% faith that AI is a driver of the economy in the future, but it is not necessarily generative AI. It's a lot of the AI that has optimized software and solutions over the last several decades, and it's going to continue to improve.
What do you make of the macro backdrop? It's a backdrop that the CEO described as fluid, dynamic. You certainly saw talk and concerns of trade and of labor. Sucharita, how do you interpret that?
I think that the macro situation is candidly, it's not great. It is peak ambiguity, as a number of executives have shared with me, and that's everything from our geopolitics to our tariff situation, challenges potentially with supply chains in the future. You have inflation still looming over the U.S. economy. You have a K-shaped economy where a lot of lower-end consumers are really, really challenged. So in that backdrop, though, you have Walmart being a place of stability. It's a place where you can go for your, where you can get value. And you know that if something is being sold, there's a high likelihood that Walmart's going to sell it to you at a better price than just about every other retailer. So it is a company that is well positioned, that even in this state of consumer uncertainty, that's the reason they continue to gain share.
Well, in this stability, this is something else the CEO told Bloomberg. As we look into the coming quarter as well as the coming year, it feels a little bit more like a normalized pricing environment, and that tariff-driven inflation has reached its peak or is about to reach it. Sucharita, there was a story in the Wall Street Journal over the weekend saying that we hadn't reached the peak, that companies are only just going to start raising prices after they finish stockpiling and trying to preserve margins. They're going to start raising them. So is this Walmart specifically that's being able to reach its peak of price hikes, or is this industry-wide?
I don't see that there is much more consumer appetite for higher prices. What we have seen is that retail in the last few months has essentially been growing at the level of inflation, and even a little bit lower, arguably. So what that means is that people are purchasing fewer units of things. That's not a good thing for most retailers. That is not a formula for long-term success. So anybody who thinks that there is more room to raise prices for mass goods, I don't think is actually looking at the specifics of what the average consumer is purchasing. There may be room to increase prices, kind of for trips to Vegas or, kind of eating out or some luxury discretionary items. But I certainly don't think that there is a lot of room to continue to raise prices in most grocery goods.
Sucharita, we're going to have to leave it there. Thank you so much for joining us this morning. Forrester Research retail analyst Sucharita Kodali. Coming up, more on the state of the consumer with Booking CEO Glenn Fogel. That's at 9:40 a.m. In just a few moments' time, we'll also have your opening bell for you. Stay with us. This is Bloomberg Open Interest. Only a few moments to go until your opening bell. We are on track for declines, about 1/3 after 3 straight days of a rally. The equal-weighted index, by the way, is just a stone's throw from an all-time high, underscoring that it is big tech that's been underperforming. That continues at pace today. So only a few moments to the opening bell. We're going to start the trading day with Charles Schwab Chief Investment Strategist Sonders. Stay with us for that just after this break. And let's kick off your trading day. This is Bloomberg Open Interest. I'm Dani Berger. Matt Miller is off. Here we are at the open. Futures down about 1/3%. NASDAQ also down 0.5%. Some people pointing to the volatility in oil markets maybe weighing us down. Uncertainty between the U.S. and Iran capping 4 straight days of gains. The bell ringers this morning at the New York Stock Exchange, Centris. These shares have almost doubled so far this year. They're an uranium enrichment company. They're expanding in Ohio and probably feeling pretty great. Also feeling probably pretty great because they're on a sugar high of all the soda that they've just drinking is the MLB and Pepsi because, guys, huge news. Baja Blast is the new official soda of the MLB and ends a 6-year drought where the MLB had no soda. What a travesty. So yeah, Baja Blast, take that what if you will, holding it up, feeling good, official drink of the MLB. Anyway, let's look at things that matter. It is the moves this morning. Look at what Walmart's doing. This is a stock that had declined pretty rapidly after it came out with earnings in the pre-market. It has turned things around, up 2.4%. It missed expectations for its outlook, but we're just talking with Sucharita Kodali of Forrester, who said these earnings were really good. Others pointing to the idea that they're always conservative to start the year. Then there's Deere, another set of really strong earnings, up 7.7%. The profit outlook topped estimates. Executives say that 2026 is the bottom of the agriculture economic cycle. And then there's Figma. Those shares also up a nice bit, up now under 1%. Solid sales outlook, and that helped ease fears that there would be AI disruption for the software company. Now, for this overall market, we've seen a lot of divergences. Goldman Sachs saying that large cap active mutual funds are outperforming their benchmark in 2026 by the highest margin since 2007 as investors look beyond big tech. Charles Schwab Chief Investment Strategist Sonders notes something similar, that over the past year, only 21% of stocks within the S&P 500 have beaten the index itself. Over the past month, it's 62%. And Lizanne joins me now. Lizanne, is this just evidence that you can't just buy the index and chill, that you have to be more choosy right now?
Yeah, I think it is evidence of that. And we've had the view that you want to sort of shift away from monolithic investment decision making, which in years like 2024 and even at the start of 2025 made sense, particularly cohorts like the Mag 7. That's no longer the case. And there is more connectivity to actual fundamentals, the direction of travel in terms of forward earnings estimates, and that's provided a lift to other segments of the market, leadership areas like energy and industrials and materials. It also helps to explain why non-US is outperforming, because embedded in their economies are more of those traditional cyclical industry and sector drivers as we see diversification away from just mega cap tech. And I think that has legs this year.
I was going to say the reason that in the past it worked to buy the index is because of how exposed it was to the Mag 7, to mega cap tech. It's also embedded in this idea that there is more dispersion, one in which the mega cap stocks, the tech stocks, just won't do for you what they used to, that it's no longer a world in which if you want to outperform the index, you have to be overexposed to that sector.
Yeah, I mean, even last year, and this is I find a phenomenon that is often the case within the retail investing community, is conflating the notion of contribution to return and performance rank. As an example of that, NVIDIA, the best performer last year among the Magnificent Seven, and it was the #1 contributor to S&P gains, but it was the 75th best performing stock within the S&P. So there's actually been plenty of other areas and names where you did well from a performance standpoint. The contribution rank being much higher comes by virtue of the multiplier of the cap size. So as a retail investor, you're not benchmarked on a quarterly basis to the cap-weighted S&P 500, and I think it's being brought more into the light that there's more fish in the sea than just that small list of names.
Those fish in the sea, though, are jumping a lot, if you can forgive me for really torturing your metaphor, Lizanne. I was looking at this statistic coming from Scott Rubner at Citadel, saying that over the past 30 days, the S&P is down 1.4%, but the average stock in that index has had an absolute move of 10%. If you're going to be a stock picker, how do you handle that single name volatility right now, Lizanne?
Well, I think there are ways to do it in a somewhat safer way. It could be making sure you have exposure to, say, the equal weight S&P, not just the cap weighted S&P. Have some exposure, maybe in a more index way, down the cap spectrum. So I think that's one way to think about it. Trying to anticipate some of these rapid fire shifts within the market, some of these rotations, in large part recently driven by AI as it cascades into the economy. We're focused not just on the beneficiaries, think of those as the shiny new objects, but we're focused on who's being disrupted. And some of those rapid fire shifts, trying to anticipate them in advance, I think is a bit of a fool's errand, which is why you want that broader diversification within the US equity market asset class, and as well to overseas markets. It's also the case that the churn and rotation has meant there's been dislocations within the market. S&P has only had a couple percent drawdown, maximum drawdown at the index level this year, but the average member has had an 11% drawdown. So that's correction territory. The average member within the NASDAQ has had a 24% drawdown this year. We'd all prefer that over the indexes sort of compressing by that much all at once, but it's happening via a process of churn and rotation.
Listen, where are you looking abroad? The Stock 600 in Europe at a new record. There was also recent data showing that foreign investors are investing in Japanese stock markets at the fastest clip since October after the, Prime Minister Takaishi and a success in an election there. Where is the most attractive globally for you?
Yeah, so we don't go down granular into country by country. We tend to stay at the index level, and we've liked both MSCI EFA, which has developed international markets as well as emerging markets, understanding that the volatility and risk profile inherent in EM means that for investors that are more on the conservative end of the spectrum, it probably makes more sense to stay in developed international markets. Those on the more aggressive end of the spectrum could add that higher volatility EM piece. So we've been favorable toward international markets really for the past couple of years. And I often joke that, recommending international diversification for a long time meant constantly having to say, I'm sorry. And now we get to say, you're welcome.
I love that. It's time for a victory lap, Lizanne. Hey, just before I let you go, because we had FOMC minutes yesterday where it showed a real divide and a more hawkish tilt to that divide of some members of the committee talking about hikes. Do you think that this is a market that is overly optimistic on the cuts we're going to be getting this year?
Well, we've slowly been pricing out cuts. We're still at 2, but the second one is pushed out, and I think that will continue to reprice. We're seeing much more dispersion within the FOMC in terms of their expressed views. It's showing up in the number of dissents, some of the commentary we've seen recently. It showed up in the minutes. We see it in the dots plot. We see it in the summary of economic projections. I think that's all else equal a healthy backdrop, especially given ongoing concerns about politicization of the Fed, threats to independence of the Fed. When you have sort of more and louder voices expressing disparate views, I think, again, all else equal, I think that's a relatively good phenomenon, especially as it relates to concerns about the threats to Fed's independence.
Lizanne, thank you so much for joining this morning. We always appreciate
Thanks
your
for
time.
having me.
That's Charles
Thanks,
Schwab,
Dani.
Chief Investment Strategist, Lizanne Sonders. Let's get a check on your equity markets 8 minutes into your trading day. It is a down day after 3 consecutive up days. Down just about 0.5% breadth is decisively to the downside. More than 330 stocks falling compared to just over 100 gaining. In terms of the gainers, it is going to be your earnings-related movers. Deere, a company you usually don't see at the top of the pile for contribution to the S&P, adding about 1.3 points. Solid earnings. Walmart, they missed on expectations, but was it a low bar that they've set for themselves that they're just going to continue to beat? So the market liking what they're seeing from the new CEO there. The reason the market is likely down is because of what big tech is doing. It's what Lizanne was just talking about. The weightedness of this market towards big cap tech not necessarily helping you if you're buying the index. Nvidia down 1%, Apple down 0.6, Tesla down 1.5% on just recent news out that Kathy Hochul of New York is revoking Tesla's New York robo-taxi plan. Let's look at some of the sectors. Again, tech not having the best of days today. It's one of the third worst performing. Consumer discretionary, that falls 1%. Carvana, I believe, is in there. The car rental company or sales company that's seen some prices stack up. We're going to talk about that later in the show. Energy at the top of the pile as oil moving higher on concerns over U.S. and Iran negotiations. Coming up, we're going to get to another earnings story. Booking Holdings, the company behind Priceline and OpenTable, tops expectations. We're going to talk to the CEO, Glenn Fogel, on how he's positioning the company to win in the age of AI. This is Bloomberg Open Interest. Let's get you some top calls. The analyst action that we're watching this morning. First up, Stevens cutting Cheesecake Factory after fourth quarter sales fell more than expected at the restaurant chain. The analyst says upside looks limited without a clear lift in earnings. Next up, Raymond James upgrades Chewy, saying the recent pullback creates a buying opportunity. They see room for sales and profit growth this year. And finally, Wall Street weighing in on a strong quarter for Bookings Holdings. Citi says that results show the outlook with a broad strength. Evercore ISI says core trends remain solid despite slightly softer profit guidance. The company also announcing a 25-for-1 stock split. Let's get more details now from the company's CEO, Glenn Fogel, who joins the program. Glenn, great to see you. And look, the analyst said it there. It was a strong earnings, so maybe we need to talk about the elephant in the room. Shares are down 8%. I can only imagine it's AI anxiety that seems to continue to be souring a lot of companies so far in the market these past couple weeks. What is your response to concerns that AI is going to disrupt booking?
Well, first, thanks for having me. And I got to echo what you said. I mean, last night coming out with the numbers that we put out were just stellar. The whole year has been, even though the world's been volatile and we've had all these economic issues, we still power through, accelerating each quarter and being able to come in almost adjusted EBITDA, almost $10 billion, returning over $8 billion to the shareholders. This is just fantastic, going well. And it's interesting, too. It's not like the world changed anything from what we said last night that would cause people to be more concerned about AI affecting our business. In fact, AI is a positive for our business. That's what's so interesting. And I'm not sure anything I said that would have caused anybody to think anything different, but clearly it's going to take some time for this all to shake out and that people see the benefits that we are producing through AI.
Well, let's get to it, because the criticism maybe goes, I can open up my Gemini or ChatGPT or whatever and have it book for me at some point, my entire trip, a hotel, a flight, and cars. So why would I need Booking Holdings and any of the companies under your umbrella, Glenn? What would be your response to that?
Well, we don't have the time to go through all the reasons, and there are a lot why that is not the way the world is going to be. But I will say that here's an example of a path in the past where people have tried that. Look at Google, enormous company, very big at the top of the travel funnel. People go into Google first, trying to figure out what they wanted, and Google tried. They actually did do this thing called Book on Google. And then they pulled back from that. Why? Because this business is a lot more complex than one would think. I mean, the supplier proposition that we deal with over 4 million properties globally. And it's not all they just put in the prices and the availability up. This is some of the connectivity you got to work with day by day. And it's working with these managers of these properties in terms of what should they be putting out in terms of sales, in terms of geo prices, mobile prices. We have our loyalty program, Genius. I mean, we talked last night about mid 60% of the people are coming to us direct. And we have those AI tools, and we're making even better. So you can do your entire trip. It's not just the hotel, it's the flight, it's the ground transportation, it's attractions, what you do. Putting that all together, stitching together with AI produces a much better thing. And then the customer service and the trust that it'll actually be done right. That's really complicated stuff that we do so well. And by the way, you tell me Gemini or ChatGPT are going to do this. Well, have fun with the merchant of record issues and regulations. I mean, if you go to Europe, all the issues you have to deal with in terms of making sure you're doing this within the regulatory framework, I do not believe that the tech companies, and this is proved by Google, when they see how difficult it is, how much you need boots on the ground, they'll say, we can make a lot more money on advertising, which is what Google does. And together we made a lot of money. Now we're doing it with ChatGPT, where we are one of the first people in. We're putting in advertisements at the bottom of the results that come out of ChatGPT. Perhaps they will move into more a Google way in terms of using an auction method for advertisers, which would be wonderful for us and good for them. We'll see what happens. But the idea that people are going to be going to a large language model and doing their booking and it's all going to work fine and no problems, I do not believe that's the way the world's going to work.
Glenn, I got to say, I really do feel for you. I mean, it's a lot of CEOs in your position that are having to deal with this, that a market that's just like throwing everything out with the bathwater because they don't know how things are going to look. I'm curious from your end, what has it been like to onboard, to hire, to find AI talent that can guide booking into this next era? Because all of this feels relatively new. How difficult or maybe easy is it to get a handle of how you reshape booking to incorporate some of these AI tools?
Yeah, so I've been in the company now 26 years. This is my 10th year as CEO. And yeah, look, technology has been changing over thmore than a quarter of a century, and trying to get the right people, the good talent to be able to do that, that's been done for a quarter of a century. We've been doing that. It's no different now than it was in the past. And by the way, we started with AI more than a dozen years ago. Machine learning models that were being used to make sure you saw the best properties, that's AI. And now generative AI, sure. It's, you got to find the right people, but I'll tell you, we're not researchers doing the top end, and we're certainly not spending hundreds of billions of dollars to build out new models like some of the frontier players are. We're using those models. That doesn't require quite the same talent that are using in trying to come out with these new wonderful new models.
Glenn, if I can just jump in because we're running out of time, and I don't want to only ask you about AI. I want to ask you about other things too. How is your customer right now? What is the strength? What is the willingness of people not just to book vacations and book all the things that go with it, but also spend on those?
Yeah, no, people want to spend, and certainly the higher ends of the economic strata, people are definitely spending use. That's in our numbers. And we came out with the guidance that looks good. And we definitely see, assuming there are no macro events that happen, we assume that people are going to continue to do what they did in 2025, which is help explore the world. That's our mission, make it easier for everybody to experience the world. And I'll tell you, it's a wonderful time right now for travel, because it's not the excitement of going out, but using AI and all these new technologies.
Glenn, thank you so much for joining this morning. We appreciate your time. Glenn Fogel, the CEO of Booking Holdings. Coming up in other earnings, Carvana recovering after a profit miss that spurred a wave of price reductions. That's coming up next. This is Bloomberg Open Interest. Welcome back to Open Interest. Let's get a check on stocks this morning. 20 minutes into your trading day or thereabouts. Still a negative day. We're down 1/3% on the overall index. NASDAQ falling more than that, down 0.4%. Russell 2000 doing even worse, down 0.5%. We did have 3 straight days of gains. So this does cap that after losses last week, 3 weeks of losses for the NASDAQ. It's been a choppy market, especially underneath the surface. NYMEX crude, that's up 2%. There are concerns about what's happening with Iran and the U.S. and negotiations. An Axios report talking about an Axios op-ed rather, about that maybe we're not fully digesting the risks of escalation. NVIDIA, that's down 0.6%. Tesla falls after Kathy Hochul polling their robo-taxi plans for New York. Walmart, those shares now 1.8% higher after falling in the pre-market, following their earnings. Deere, also really strong earnings, up 9.2%, saying that the bottom is happening for agriculture. It's only up from here. Wayfair, a big disappointment for their growth, down 10%. And then there's Carvana, those shares down 2.8%. Any better sales being overshadowed by higher cost. Here to explain is Bloomberg's David Welch, who's in Detroit. David, what was the read we got from Carvana?
So their costs were a bit higher in their reconditioning centers. Those are the places where they do the repairs. They paint the cars that they buy from people, spruce them up so they can sell them. And they've been expanding those. And what Ernie Garcia, the CEO, said on the earnings call is some of those are running at one shift. Some of them have new managers in there. They just weren't as efficient as they have been. So overall, you had costs going up. They had a bit more depreciation in cars and inventory. The bottom line is they've been growing very fast and investing to do that. And there are probably some growing or teething pains here. Now, why did investors sell down on this thing? The thesis on Carvana, if you're bullish on the company, is that they've got this rapid growth going on. They have this huge network out there to fix cars and sell them, and it's running at about half capacity. If you can sell more cars, you just get greater leverage on that, greater economies of scale, and profits should get better. So Carvana got the growth, but EBITDA disappointed, gross profit per unit disappointed, costs went up. That wasn't what is supposed to happen. So I think investors are retreating from that, and they're going to wait and see and watch the next couple of quarters to see if the fourth quarter was a one-off or if there's a continued issue with cost rising as the company tries to expand rapidly.
Well, even if their retail sales were growing and even hitting a record, David, how much of that is sustainable if they were spending a lot, not just on the cars themselves, but on things like, hiring John Hamm and having an AI version of Shaquille O'Neal, all those marketing costs that come with that?
Marketing costs were another issue. For a while, they had really kept their advertising costs down, and this push to get awareness did cost them some money. Advertising costs were up over 60% in the quarter. They're not going to do that forever, I would assume, and Carvana was growing at a pretty good clip even before they started upping advertising spending. But that's the big question investors have. Can they get the growth, and can they get the operating leverage, the economies of scale that they're always talking about as they grow, or are they going to have to continue to spend money on new capacity and on marketing and other things in order to make that happen?
David, thank you so much. Great reporting this morning. That's Bloomberg's David Welch with Carvana. Those shares down 2.3% in the pre-market and a busy day for earnings. Coming up in the next hour, RBC's Francis Donald on the labor market and the Fed rate path, plus FTSE's Indira D on the flows into the Russell indexes. And we're also going to talk gold with Aris Mining CEO Neil Woodyer as gold moves back above $5,000. What does the outlook for mining and the precious metal look like? All those conversations to come on the second hour of Bloomberg Open Interest. "30 minutes into your cash equity trading day. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is off this week. We are weaker to start the day, down about 0.33% on the S&P. Coming up, Brent back above $70 on fears the U.S. and Iran are inching closer to a new conflict. Gold also climbing, touching $5,000 and above as investors flock to safety. We're going to discuss with Aris Mining CEO Neil Woodyer. Plus, Steve Cohen's comeback. The billionaire tops Bloomberg's annual list of the world's best paid hedge fund managers. We begin with some breaking economic data crossing the terminal, pending home sales. Michael McKee joins us now with that, and also with earlier data this morning, too, we had.
Yeah, if you're hoping for a turnaround in the housing market, you're not getting it from the pending home sales numbers. Down 0.8% after being down 7.4% in the month of December. On a year-over-year basis, we're down overall 1.2%. And that was after a 1.1% decline the prior month. So anyway, bad news on the pending home real estate side, but everybody kind of knows that's the case there. The interesting number today was the trade deficit kind of exploding, which was a bit of a surprise. But when you look at the constituents of it, it comes down to what you were just about, you were teasing your guest, gold. Right. Imports fell by $5.5 billion, but gold exports rather fell by more than the 5.5 billion that they went down. Gold exports down 7 billion. Basically, when people thought they were going to be tariffed, everybody moved their gold from Europe to the U.S., and now they're sending it out back again. So that's had a big impact on it. That doesn't go directly into GDP. So part of this goes away. It is the trade deficit rising as much as it did will make a little bit lower GDP numbers, but people aren't revising their forecast for tomorrow down too much.
Mike, we also got FOMC minutes yesterday. I mean, there was considerable disagreement. To hear about cut holds and even a nod towards hikes was remarkable within one set of committee members.
Yeah, I think the takeaway from it is not that the Fed is going to be raising interest rates anytime soon or cutting rates. They're going to stay where they are. But the idea that they put the possibility of cutting rates on the table in the minutes for the first time since 2023 is significant. It gets people thinking about the possibility that something could change. Several participants, which generally means 3 to 5 in Fed speak, indicated they'd support a two-sided description of the committee's future interest rate decisions. In other words, we could cut, we could raise, but right now, we're going to stay where we are, and that's where they ultimately landed. The best line, I think, of the day came from Paul Donovan at UBS, who said, if they had spelled the word labor correctly in the minutes, L-A-B-O-U-R, it would have reminded him more of the Bank of England than the Fed.
Yeah, I mean, he said correctly because he's British. I also love the discourse over what, like, some, several, few, like how you sort of dissect all those Fed speak words.
The Fed actually, 4 or 5 years ago, came out with a list that sort of gave you an idea of how many is in each one. But in this time, they also added one that we hadn't really seen before. Instead of just saying the majority, they said the vast majority. Now, we don't have a description of what the vast majority is, but I assume it's a lot.
They need a new playbook now for what vast means. Mike, thank you so much for joining. That is Bloomberg's Michael McKee. Let's continue the conversation with RBC chief economist Frances Donald. Frances, if I can start with you on minutes. If you are getting some very wide dispersion in the conversation with nods towards every form of what might happen for rate decisions to come. Has this market been too optimistic on cuts to come for 2026?
Well, you're coming up against the 5-year anniversary of inflation above the 2% target. I mean, we have not solved this inflation issue within the United States. And even though it might be heading in the right direction, the job is not done on prices and affordability issues. And meanwhile, that unemployment rate is declining. So even though we don't have a lot of job creation, it's becoming increasingly clear we don't need a lot of job creation in the United States. So if you woke up from a coma, you had not seen anything happening in the past 2 years, and I told you got inflation sticky near 3% and an unemployment rate of 4.3%, you would say, well, that's a hike environment. So no wonder we're starting to wonder, is there really, should we have this two-direction element to the U.S. economy? And I think that's appropriate.
So what's your expectation then on what the Fed does from here?
Well, this is a Fed that's going to be on hold for this year, but they are going to have to reconcile with some of these complicated elements of the U.S. economy. Cyclically, yes, there is some evidence of slowdown in the private sector, but structurally, there is so much changing. We are moving towards jobless growth, or I prefer to say productivity-led growth. That's maybe a more optimistic spin on it. They're still reconciling with a significant amount of lack of clarity in the data. We're getting, as Mike just mentioned, distortions from gold prices that are impacting the trade deficit. We still don't have total clarity on inflation from government shutdown 1 and 2.0, which momentarily created a pause in data as well. And we're still getting distortions from those tariff announcements, which have created inventory pull forwards and some kind of complicated elements reading GDP as a result of that. So this is not a simple environment. Of course, there's different interpretations. Monetary policy is not simple, and it's particularly not simple in this environment.
Well, let's add the other complicating factor of the balance sheet with an incoming Fed chair, Kevin Warsh, who wants to significantly shrink the presence of the Fed and its impact on bond markets. How does that play into all of this complication?
Well, that's another element of this is he actually going to be capable of doing anything? So there's ways to maybe get the job, and then there's what you can do in practice. Looks like we're going to have to wait and see what he can actually do when he gets into the role.
How about the impact of oil on inflation? Because there was an Axios op-ed that warned that the U.S. and Iran might be heading closer to a major conflict. Then you get the prices of oil moving higher. It's been quite benign so far, but finally above $70 a barrel. Should we start to factor this into the direction of the U.S. economy?
This is the second question in the last 6 hours I've gotten on, do we need to start worrying about oil? Not at these levels. This is not a dramatic change to gasoline
I'm surprised
prices.
It's only the second one.
It's only the second one in the last couple, this morning.
Okay, got it.
But what I will say is the gasoline, the perception of affordability in the United States by consumers is very driven by the prices of things that they buy regularly that have clear price tags on it. And that includes things like gasoline, food prices, electrical bills. So as much as we wouldn't see, for example, a huge move in gasoline prices off this move in oil, at least at these levels, we do have to be mindful that the only real high frequency purchase that Americans have been making that has seen some downward move is the gasoline side. Food, rent, childcare, electricity, those are all moving in the wrong direction. So the reason that my eye is on oil, maybe a little bit more than usual, is not because the price move has been so significant, but because that has been a factor that has helped to mollify a bit of this affordability issue that's come through. And if we were to lose that, that would be a little bit more problematic for President Trump's affordability story.
I was going to say, it's a White House that has been now squarely focused on, okay, well, not squarely focused. They're focused on a lot of things, but the affordability thing has been something that they're really, really piling into. Does that even just increase the threat of inflation if there is more stimulus coming from this White House, adding on to the one big beautiful bill and the measures they've already put in place?
Well, we believe that inflation is going to stay around. We call it 3-ish, very precise for economists, 3-ish, because it depends on what sort of measures you're looking at. And it's coming from 3 areas. One is goods prices. We are still seeing that tariffs roll through the system. Not extraordinary, apocalyptic type of inflation in goods, but it has moved gently higher. Then you have that shelter measure, which is faulted. There's a lot of issues with it, but that isn't going to come down as quickly as folks hope. And then the services measure, and this is where the stickiness in inflation is going to persist through 2026 and into 2027. Why is services inflation slightly higher? Why is there a floor under it? Some of it is the tightness of that labor market, and another part of it is we're in a fiscally driven cycle. There's a significant amount of fiscal stimulus in the system. There's more coming through in the first quarter of 2026. There's no question that that is contributing to some of the resilience of those inflation figures. But at the end of the day, what Americans are going to want to see is, can food prices, rent prices, electricity, and gas, can these stay contained? And if they do, then even if CPI is around 3%, consumer perception of it might be a little bit easier.
All of this, I have to say, Francis, just sounds like a collision course waiting to happen between the Fed and the White House. I realize you didn't get into this job to become a political analyst. Unfortunately, maybe increasingly that's happening for you. Do you have concerns around jawboning from the president, any issues of Fed independence, maybe fiscal dominance, anything like that, if you do have this tension of a president who's been very vocal in wanting lower rates and the headwinds to the FOMC to being able to do so?
Well, instead, the economist's perception of that is we're going to put the noise aside. Let's look at the data. And when we do that, what we see is a global trend of not a collision course, but a baton pass. Maybe that's the better way we can put it, of central banks really being the drivers of the cycle. There's so many times that I've sat in this chair that you've talked to guests about what is the Fed going to do next, because it's so critical to, are we early, mid, or late cycle? But increasingly what we're seeing is central banks are saying the type of change, the type of inflation, the type of growth that's in the system, it's not central to monetary policy. It's going to have to be a baton pass to fiscal policy being the core driver. That's going to be a change for the way that we think about those two factors in the economy. It's going to be a change to the type of growth that comes through. And it's also going to be a change to, I think, what we need to put more emphasis on in the headlines.
Baton pass. I love that. Definitely going to cite that from now
on.
Go
for it.
Francis, thank you so much
Thanks
for joining this morning. Francis Donald of RBC. Let's get a check on your equity markets this morning. 40 minutes into your trading day. We're off the worst of the losses, at least for the NASDAQ. Now both the NASDAQ and S&P are down about 1/3%. 10-year yields going a whole lot of nowhere. There's the Brent crude price that we were just talking about, above $70 a barrel, now trading at 71.22 cents after that Axios op-ed that the U.S. and Iran might be heading towards a risk of escalation between the two as negotiations falter on nuclear deals. Let's get a look at some of the single stocks that are moving in this hour. Walmart, a turnaround for this company, initially fell pre-market when it reported earnings because of a cautious forecast, but it did beat expectations, pointing to an unpredictable state of trade and labor market conditions. Are they just setting the bar low? Then there's Deere. They posted its annual profit outlook, saying that it expects the agricultural economy to get better soon. And then Figma gave a better than expected annual revenue outlook, easing fears over AI disruption to the company. Shares up just under 4%. And don't miss our interview with the Figma CEO, Glenn Fogel. That will be at 2 p.m. New York time. Coming up, Indrani Day of FTSE Russell saying global equities lack decisive leadership. She joins us to discuss her quarterly report. That's coming up next. This is Bloomberg Open Interest.
We've had the view that you want to sort of shift away from monolithic investment decision making, which in years like 2024 and even at the start of 2025 made sense, particularly cohorts like the Mag 7. That's no longer the case. And there is more connectivity to actual fundamentals, the direction of travel in terms of forward earnings estimates. And that's provided a lift to other segments of the market, leadership areas like energy and industrials and materials.
That was Sonders of Charles Schwab speaking with me about her outlook for equity markets. Joining us now is Indrani Day, head of global investment research at FTSE Russell. Indrani, thank you so much for joining this morning. And look, you've been writing research, kind of something similar to what Lizanne was saying, that this is a market that lacks leadership. For so long, you could buy what were the leaders, the Mag 7, buy it at the index level, just chill, don't do anything with your holdings. Just how different is this environment now?
Thanks. So I think, we have gotten very used to the world that happened between the great financial crisis until about end of 2024. You could just buy United States stocks, particularly the technology growth stocks, and you're all set. It is really the leaders. Something shifted in 2025. Changes are in the making for a very long time. And when the repricing happened, then the repricing picks up momentum. So 2025 is a very different year where ex-United States was far ahead of the US. You had emerging markets much more than the developed markets. You had small caps pulling up. So it was literally all the quote unquote unloved parts of the market that were coming into focus. And 2026 has been more of the same on an accelerated basis. That's because things have fundamentally shifted. The global rally has kind of really diversified, and it's on many more legs right now. It's not just a tech AI story as it is in the United States. The AI players, the number of people benefiting from it has diversified. You have all the geopolitical risks because of which gold mining, precious metals coming into play. You have the green transition, the EV, the battery. That is certainly this EV transition is green transition is continuing in the rest of the world. What does it mean for the supply chain up and down that? So there are just so many players, yield curve steepening, financials coming into play. So more industries, more sectors, more countries, the broadening out, which means unexpected parts of the market, unexpected meaning if you go by the past long-term trends that are coming into focus and really pulling ahead.
So they're pulling ahead, but what is the dividing line in between a normalization, catching up to what the loved parts of the markets were doing, versus taking the reins of leadership and being the thing that can help drive overall markets higher?
So if you see where the outperformance has really happened in 2025 and 2026, you have countries like South Korea that have really benefited both because they are an AI play at far cheaper valuations. Japan is having a whole lot of changes happening both in its domestic market and more expected from the Takaishi event. You have emerging markets that after 10, 15 years of making improvements to their macro model, their fiscal balance sheets, their current account balances. According to World Bank, their governance has really improved. So there's a complete re-rating of emerging markets. And I have to say, the re-rating of emerging market equities is the last part of the emerging market re-rating started in their sovereign bonds. Not surprising, right? Because bonds are all about risk control. Will you get paid? Repricing happened there. Then it followed through into their forex markets with their currencies strengthening. Many of the EM currencies have been very strong. And 2025 is when it shifted to equities, because equities are about the upside, the long term. So the world is now really repricing. Something has fundamentally changed in emerging markets. They are so diversified. They have a huge technology exposure, financials exposure, materials exposure. Governance is better. Fundamentals are better. So, the risk is really low. People would be surprised, but if you look at the numbers, the volatility in EM equities over the last 10 years has either been in line with developed markets or actually lower in stress periods like the COVID era. So all that repricing is now coming into focus. And this year also emerging markets are outpacing developed markets by a larger margin year to date than in 2025.
It is a rethink. It is certainly a rethink, because if you were to close your eyes and say, map out the volatility of EM versus US, that's probably not what you would do. How difficult is it when you speak to clients, when you're putting your research out? Is it difficult to say, okay, you need to release your big cap tech bias? Because people have held that for just so long at this point.
I think it's a little easier now in 2026 because 2025 showed these patterns to be right, and we were pointing to these trends from around end of 2024 because we were picking a, it's important to look at the drivers, the forward-looking indicators and what they are saying, because by the time something is already priced in, well, it's already priced in. So to us, it's not very surprising as we were looking at the data. But yes, I think increasingly as we talk to people, they're more interested in the idea, yes, a fundamental shift has happened. This is not a short-term tactical mispricing. It's a structural mispricing that is now getting corrected. And if I had to put some, very broad context numbers, look at it. Emerging markets as a part of the all-world equity, even as recently as about coming out of the GFC, it was about 13 percentage points. And a year or so back, it had dropped to 10 percentage points. But as a percentage of the global GDP, they are 40%. Expected to be 45% by end of this decade. Their macro growth, earnings growth is 2 to 2.5 times that of the developed market. Lower risk. So that repricing.
Is there an issue, though, if big cap tech doesn't play along? And I ask that specifically because a lot of the broadening out has been these smaller companies are going to see a big benefit from AI, either because they become more efficient, or maybe they're an ancillary trade, they're the picks and shovels, or they're building infrastructure. If big cap tech doesn't do well and they can't keep spending, doesn't that kind of damage some of the other broadening out trades that we've seen?
So the broadening out can happen in many different ways. Let's turning to small caps. So both in the United States and in Europe, you have seen small caps really pull ahead. In the US, you had a phenomenal small cap rally. It's about 7 percentage points ahead of the large caps year to date. So what is happening is, if in the United States, if the tariffs are to work, if the policy of reshoring were to work, then who would be the main beneficiary? Companies that have a higher exposure to the United States economy. So the large caps, less than 60% of their revenue comes from the United States. The small cap, Russell 2000, close to 75 or 80% of their revenues come from the United States. If you look at technology sector for the large cap, less than half their revenue comes from the United States. It's global. So if somebody were to make a bet on the United States economy, then today the Russell 2000, the small cap index would be the place to be. And of course, the domestic exposure also happens in, they have much higher weightage in, financials and industrials and healthcare. So the exposure, the diversification, and small caps globally always benefit when there is a rate-cutting, rate-hold environment. You saw that in Q2 of last year when the ECB was cutting rates, European small caps pulled ahead of the large caps. In the United States, third quarter, when the Fed was cutting rates, in the US, small caps pulled ahead. So they have the cyclical tailwind, and there is a broader structural widening out.
Indrani, thank you so much for joining. This has been so fascinating. Really appreciate your time. That's Indrani Day of FTSE Russell. Now a quick look at high interest, some of the stories making headlines around the world. Minneapolis Fed President Neel Kashkari says White House criticism of a New York Fed tariff study threatens central bank independence. He slammed National Economic Council Director Kevin Hassett for calling the research, quote, an embarrassment. Kashkari also pointed to a Justice Department probe into Chair Jerome Powell, warning that political pressure is targeting monetary policy. The electronic trade platform Tradeweb is bringing prediction markets to Wall Street. The bond trading giant struck a deal with Kalshi to show real-time prices on event-based contracts and may add trading access later. Tradeweb is also taking a stake in Kalshi, a major trading exchange race to tap the fast-growing prediction market space. New York Governor Kathy Hochul has pulled a proposal that would have allowed commercial robo-taxis outside New York City. The move is a blow to Alphabet's Waymo as it tries to expand its driverless fleet. Waymo says it will work with lawmakers to advance the issue, citing strong demand from New Yorkers. Alphabet shares slightly higher. Tesla, though, those are about lower, about a fourth of 0.1%. Still ahead, we're going to speak with Neil Woodyer, Chair and CEO of Aris Mining, as gold surpasses $5,000 yet again. Stay with us for that conversation coming up shortly. This is Open Interest. Markets down this morning after 3 consecutive days of gains, down 0.2 for both the S&P and NASDAQ off the lows of the morning. 10-year yields going a whole lot of nowhere as Brent crude rallies. Coming up, gold rises above $5,000 with Fed uncertainty, geopolitical risks. We speak with the CEO of Aris Mining just after this break. Gold prices climbing to $5,000 and above, with traders focused on the Fed's next move and ongoing geopolitical uncertainty. And that renewed strength in the precious metals underscores the growing appeal of gold producers. Joining us now is one himself, Neil Woodyer, Chair and CEO of Aris Mining. Aris operates gold mines in South America and is pursuing ambitious expansion plans. Neil, great to see you. Thank you for joining.
Thank you very much.
And maybe underscoring those plans is that you're switching to the New York Stock Exchange main board. So congratulations on that move, too. Part of the excitement around gold and gold mining has been the price of the precious metal, which has grown a lot. I would just love your view. We're above 5,000, just the sustainability in the gains of those prices.
I think in today's climate, it's very sustainable. Politics is, shall we say, a little bit more confused than usual.
That's fair.
Some of the rules are changing. Economically, if you look at American debt, the de-dollarization, it all leads towards gold. It all leads to a safety currency, and which gold provides. So gold has been riding high, and I think it will continue to do so for some time.
It is remarkable because I remember people talking about like $3,000 was when you'd see some real price destruction, that at that point that there would reach a ceiling. I mean, is there that level anymore, or is gravity not applied to the precious metal?
I think it's really difficult to say where it's going in terms of a number. Quite definitely, it's where it is, very strong. It's going up. People will make a judgment. Some say 6, some say 7,000. I don't know.
So what a time to be expanding operations. And I know Colombia is one of the places that you have operations. You're also set to expand there. I would love to know how you're thinking about the politics. You have both a parliamentary and a presidential election coming out. How does that impact you, or how do you shield yourself from any potential impact?
Oh, Colombia is very democratic. The present president has one term. He stops in 4 or 5 months' time. A new president will be elected. They have a strong history of democracy elections. They have a strong rule of law in terms of business law. I think a good example of that is recently we negotiated a compromise on an arbitration. Our predecessors were suing the government for $350 million for underperformance and not helping them get access to some of their territories. We decided that it was a bit silly suing the host government if we could negotiate, and we successfully did that. We negotiated and closed a negotiation about 3 or 4 months ago. So the government is flexible. It will respond to business. So a good environment from that point of view.
I mean, there has been resource nationalism in Latin America. Chile, for example, 2023 passed a progressive mining royalty. Peru has discussed it before. What do you see as the outlook in Latin America for these types of measures?
Well, I think looking specifically at Colombia is a strange situation because it has a very much, in some ways, undeveloped gold industry. It's ranked about number 40 or 50 in the world, but in actual fact, it probably ranks number 10. 85% of the gold mined in Colombia comes from informal mining. Commercial mining, such as ourselves, only account for 15%. There are 350,000 independent informal miners in gold. What we have been doing, we found a formula where we work with them. In one area, they've been mining for 350 years, and we now formalized them about 2 years ago, the first group. And we help them they have knowledge we don't have. They're part of the community. They're able to work in smaller areas. We come in with machinery, bigger ideas, strategy, access to capital. Putting these together, working in partnership with them, has been a tremendous success for us and gives us a good formula for working in Colombia.
Do you have any discussions with the U.S. government in aiding you? I mean, I realize it does not make sense necessarily to compare anything you're doing to oil operations in Venezuela, but this has been a U.S. See, I know you're laughing because it is a completely different thing, but the U.S., I mean, you can say they've been active in ensuring that foreign and friendly, both Western and American companies can get resources in the region. Is this a U.S. government that has discussed anything with you at helping to sort of move operations along in governments?
No, but we're well aware of what's going on both in Venezuela and in Colombia. It certainly helps our positioning and helps us in sort of discussing things with the government.
Well, one of the things that you pointed out was and I actually didn't realize this, that there are fewer than 15 gold companies worldwide that produce more than 1 million ounces. And you're very confident that you're going to be able to join that club. What has to go right to be able to do that?
Well, when we started 4 or 5 years ago, we've acquired 2 mines, which produced last year 250,000. We're expanding both. This year we'll produce 300, 350. In a year to 18 months' time, we'll be at 500. We have 2 additional projects, one in Colombia, which has been through full feasibility. We will be applying for the mining license in about 4 or 5 months' time. And we have one in Ghana, and we're finishing the studies there. I hope we can start constructing next year. So 5 or 6 years, we have 1 million ounces from our own resources. And as you say, there's only about 15 companies that produce 1 million ounces. So that puts us on a good track, which is part of why the market's recognizing our price over the last few months.
Is there more consolidation to come? Are you looking also at acquiring other gold miners as you move forward?
I think at the moment we have our hands full implementing the strategy that we're following. It's a very clear, simple and straightforward strategy, easy to articulate. We're going from 200 to 300 to 500 to 1 million ounces from our own resources. Something else will happen along the way, but I don't know what that will be.
Ain't that the truth? Neil, thank you so much for joining. Really appreciate it. Neil Wood, your chair and CEO of Aris Mining. Let's get a check on your equity markets. Just over an hour into your trading day. We're off of the lows, so we're slightly inching higher. Maybe we'll end this day in the green. If we do, it'll be the 4th consecutive day, up about 0.1% for both the S&P and NASDAQ. NASDAQ underperforms. 10-year yields going a whole lot of nowhere, despite the fact Brent crude up 1.5%. We're going to discuss this later in the show, but at that Axios op-ed warning about a escalation of a conflict between the U.S. and Iran. Let's look at some of the single stocks that are moving at this hour. Hims and Hers have agreed to buy digital health company Eucalyptus. It's a deal worth up to $1.15 billion. Molson Coors, they delivered a disappointing revenue forecast for 2026. The company continuing to contend with weak demand for beer. Shares down 5.2%, even though I thought beer was supposed to be acyclical, but apparently not. Wayfair getting hurt even more, down 8.8%, reporting a decline in active customers last quarter, raising concerns despite otherwise solid results. Coming up, billionaire Steve Cohen becomes the world's best paid hedge fund manager. Last year, we're going to discuss Bloomberg's annual rankings. That's coming up next. This is Open Interest. Billionaire Steve Cohen has taken the top spot on Bloomberg's annual list of the world's best paid hedge fund managers for the first time. Cohen's total earnings from his hedge fund, Point72, came in at $3.4 billion in 2025. Bloomberg's Hema Parmar did the methodology and joins us now. I know that this is a labor of love that you do every year, so thank you for bringing it to us. So Steve Cohen, I mean, the man's on top.
It's amazing. He is on the first place for the first time in the many years we've done this, raking in $3.2 billion that he took home last year. And, you know, his fund has really made this amazing comeback. In 2018, after having to return money, he made a comeback as a hedge fund, raised money. They got about $4 billion-ish at the beginning. Now the hedge fund, just 8 years later, $45 billion big.
Who else was notable that made the list this year?
Yes, so we have a lot of the big multi-strat hedge fund managers, the likes of Izzy Englander, Ken Griffin, a lot of the big names that we talk about very often on this show. We have the most number of hedge fund managers that have made the $1 billion club this year than any other year. So you're looking at multiple people that have walked home with at least $2 or $3 billion, and about 9 who took home about $1 billion.
What's behind that? Is that just outperformance, basically?
So it depends on the fund. If we look at Steve, you can take a look and see that the large portion of his gain came from his personal investment in the hedge fund versus fees. If we take a look at some of the other multi-strategy funds, like of Izzy Englander or Ken Griffin, it's closer to being a bit more split between the fees being quite lucrative, as pass-through fees is what these multi-strategy hedge funds use, and they can really make the economics of running this giant, complicated fund more attractive.
What about any newcomers? Anyone surprising make this list?
So we have a newer comer. His name is Josh Resnick. He's been on our list before, but I think last year was the first time. So he's newer to this list. He made about 40% in his hedge fund last year. His hedge fund is a bit smaller AUM-wise, but he still walked home with nearly $700 million in profits.
Emma, can we just make one note that you and I were talking about on the break, that this is decisively a list of men?
It is an all-male list. We are hopeful that one day we will see an amazing female manager make this list. As of now, and historically, the 6 years we've been doing this, or 7 years, it's always been Titan male hedge fund managers.
Yeah, we would love to see that change one day.
We would love to.
Thank you so much for joining in. Again, great reporting, Hema Parmar, on the paydays for the hedge fund titans. Let's now turn our attention to private credit. And Blue Owl, the firm, said that it will restrict withdrawals from one of its retail-focused private credit funds, reversing a previous plan to resume redemptions this quarter. Let's get more with Bloomberg senior reporter Silas Brown. And Silas, this was also the fund that we already had some controversy around, right? That was going to merge with a public fund, and then those plans were shelved.
Yeah, you're right. I mean, it's had a bit of a tricky past few months, but I mean, I think it's reaching some form of conclusion. I think Blue Owl has taken the decision to basically sell direct lending investments across 3 funds and distribute portions of that cash to investors, which is a novel way of dealing with investor withdrawals and sort of dissimilar to the kind of conventional wisdom, which is to basically handle investor redemptions on a quarterly basis. So it's a kind of novelty. I mean, the fund itself it's dissimilar to the classic non-traded perpetuals that we see more frequently nowadays. So it has its own kind of kinks and kind of curiosities, but I mean, I think the headline thing is that this is a sort of this is a conclusion of a rather kind of chaotic episode for this fund.
Is there a way in which we can expand this out to the sector as a whole, Silas? Because when you have these retail traded private credit funds, the criticism has always been a liquidity mismatch. Does this speak to that?
Fantastic question, and I think that is right. I mean, I think if you spoke to private credit funds over the course of their history, they say one of the great advantages with this market is that we don't have liquidity mismatches that have felled banks and other financial institutions for decades previously. And I think the issue more broadly for private credit is they, in a bid to attract retail money, they've developed these structures through the BDC industry. I mean, for a long time, but it's reached a sort of fever pitch in the last few years, and it has exposed some level of vulnerability for the industry because ultimately, as is very obvious, it's an illiquid asset class. And so if you're dealing with, heavy redemption requests, it's a tricky position to be in. Blue Owl has been somewhat of the poster child of this thing. And I mean, Blue Owl, it's a big, leading private credit player, one of the largest and sort of most kind of penetrated across all of different forms of private credit, but it has found itself in the sort of epicenter of this kind of potential vulnerability for the industry.
And you can see that reflected in the share prices themselves. What has Blue Owl said about this, Silas? And by the way, we invite anyone from Blue Owl to come on the show and discuss it themselves. But what has been their response to the concerns about halting redemptions and the way that they're going about selling loans?
Well, I mean, I think they're literally on a call right now. But I think, as far as I know, I mean, they see this development as a positive thing. I mean, what they say, really interestingly, they've sold slivers of direct lending investments, and they've sold them very close to par. And I think one of the kind of more nuanced points that I think Craig Packer said was, this shows the resilience of our portfolio because we've basically given these investors sight of our direct lending investments and kind of the marks that we're ascribing to them, and they've decided to buy into them at near par, which I think is an interesting and notable point to raise. I think they see this as kind of a good win for investors and a good win for themselves. And I mean, it's certainly, I think the issue maybe for investors is not necessarily this as a conclusion, although this is still, I think, being borne out through different, there'll be different investor perspectives on it. But I think the issue is more there's been a series of different decisions being made over the fate of this fund over the past few months, and that level of, I guess, like turbulence is probably suboptimal.
Maybe you can't draw the two together, but just as you were speaking, Silas, I was also thinking about Apollo's earnings when they were talking about the degree to which they've been trading high-grade private loans. $10 billion is what they said last year, that this is a market that's more liquid and more transparent. Is this Apollo just talking their book, talking about what they're doing, the trading that they're trying to establish with private credit, or is there something to it? Is there more liquidity for this market? Is this something that Blue Owl is also trying to do and trying to highlight with their retail funds?
Yeah, I think it's important always with private credit to delineate where the sources of capital come from. And Apollo, although it is, again, alongside Blue Owl, one of the leading proponents and providers of private credit, I mean, they have a different, due to their kind of relationship with Athene and their kind of heavy, reliance on insurer capital, they have a somewhat of a different proposition to other private credit providers. And so they have lent more heavily into the kind of great expansive world of investment grade private credit, which is a sort of pretty uncharted territory for the industry. And they've been kind of leading the charge, trying to do these more complex, idiosyncratic financing deals for larger, kind of more blue chip companies. And I think their frustration is due to the elasticity of the term private credit, people are drawing criticisms on the industry when actually what they should be drawing criticisms is on leveraged lending, which was kind of where the market evolved from, but in Mark Rowan and other Apollo people's opinion, is not where the market is leading towards, which is more kind of high grade opportunities.
Silas, I promise I'm not just saying this because we're friends, but you're absolutely brilliant. Thank you so much for joining us. What a great view into this industry. Silas Brown, thank you so much from the Bloomberg team. Now, to high interest, a look at what's making headlines around the world. Speaking of Apollo Global Management told clients its top executives had no business or personal ties to Jeffrey Epstein after newly released Justice Department files named CEO Mark Rowan in past communications. The firm says any contact was limited to information shared for Leon Black's tax matters, and nothing in the new documents changes prior findings. Former Goldman Sachs top lawyer Catherine Rumler exchanged emails with Jeffrey Epstein about the 2012 Secret Service prostitution scandal. Messages show she shared non-public details about the White House review after leaving her post as White House counsel in 2014. Rumler resigned from Goldman Sachs last week after this latest batch of emails was released and publicized. A spokeswoman for Rumler said she has done nothing wrong and has nothing to hide. In other fallout from the latest batch of Jeffrey Epstein emails, former Prince Andrew has been arrested on suspicion of misconduct in public office after further details emerged of his relationship with Jeffrey Epstein. King Charles says the law must take its course. Andrew, who turned 66 today, has consistently and strenuously denied any wrongdoing. Emails to a representative for Mountbatten Windsor's office weren't immediately returned. Former Prince Andrew has not been charged. Coming up, President Trump says the U.S. has to, quote, make a meaningful deal with Iran as tensions escalate and oil prices jump. We're going to have the latest for you next on Open Interest. A check on your markets this morning, down 0.2%. The Nasdaq falls 0.3%. This from Goldman Sachs' Scott Rubner. That single stock dispersion is at extreme levels. So over the past 30 days, the S&P has been down 1.4%. The average stock in the index, though, has moved 10% in absolute terms. That places the 8.6% dispersion spread in the 97th percentile over the past decade. It just shows that on a surface level, things have looked calm, but underneath it's some real churn. We were speaking with Booking Holdings CEO, for example, earlier in the last hour, who, even though they beat, saw a very deep drop in their stock price. It's the AI anxiety that seems to be seeping into different parts of this market as investors every day look through who's going to be hit next, despite the fact that this market has had some strength in the underlying economy. I do want to point out Brent crude up 1.8%. That surge off the back of escalating tensions between the U.S. and Iran. President Trump, speaking at a Board of Peace meeting in Washington, says Iran is in a hot spot right now as reports signal a possible U.S. military operation in the Middle East. Let's get the latest from Alex Longley, who covers oil and shipping markets for Bloomberg. Alex, the pickup really started yesterday off the back of this Axios op-ed. Concerns over escalation between the two nations. What has been the reaction of oil? And if you can say this with any degree of confidence, I don't know if you can, what exactly are oil markets pricing in right now?
That's a good question. I mean, I think going back to last week, we've just had a big oil conference here in London. And the feeling going into that was that there was probably about $7 or $8 a barrel of kind of geopolitical risk put into the price. And that's kind of working from a baseline of 60 and adding the rest on. I think over the last 24 hours, you've clearly seen an escalation as Brent moves above $71 in that risk premium. But actually, probably one of the interesting things in the oil market is there's a cohort of oil traders who've been pricing this geopolitical risk for much of the year. If we look into the options market, the call skew, the premium of call options over put options, is as big as it's been at any time since the conflict between the US and Iran took place last year. So I think there's an element of this that's being embedded into options prices, and that's why you're kind of seeing, sure, maybe like a $8 to $10 risk premium in oil, depending on who you talk to. But compared to decades past, that's a relatively small risk premium given the size of supplies that are at stake here.
Right. And you, in your story, you wrote about what RBC's Halima Croft said on this, that the failure to reserve core areas of contention continues to tip the scales in favor of another military confrontation. So we'll see. Hopefully there is not one, but if there is one, what that does to oil prices. Alex, thank you so much for joining us this morning. Alex Longley from our Bloomberg oil team. Brent crude currently trading at $71.63. Coming up on the show tomorrow, Nimra Kang of North Star and John Stolfus of Oppenheimer following fresh PCE data. What will the most bullish man on Wall Street say going forward from here? Plus, we're going to speak to the Points guy, CEO Brian Kelly. By the way, it's also Supreme Court decision day. Will we get a decision on tariffs? We haven't thus far. All of that to come. This is Bloomberg Open Interest.